Okay, and welcome back, students who are taking financial accounting. In this series of videos, the theory videos for Chapter 3, Adjusting and Closing Entries. We're on video number 4, and I'm going to pick up right where I left off. But right before I do, just a word to the wise, watch the first 3 videos of this series. Also, you might want to watch the other introductory videos in the financial accounting section on the student community there under the business group, because it gives a different look at what we're covering. So hopefully you understand where we're at. If not, feel free to telephone or contact an instructor. I mean, it's a lot to take in, but understanding where you're at in the process, and remember, accounting is about understanding and application. It's not about just reading. You can read it all you want, you can't do it. Okay, you have to actually do the work. You have to do the homework problems, and the more that you do them, the better you understand what it is that you're reading. Okay, and I'm talking a lot of theory here and trying to show you, okay, here's where you're at in the process, here's this, here's that. And if you're listening, it's sort of like just taking in all of this information, and unless you're actually doing it, you really don't understand what's going on. So make sure that you do the homework problems for chapters 1 and 2, and this will give you a much better idea as to what you're doing with chapter 3. And so let's pick up right where we left off. Let me get down to that slide. Let's see here. Okay, yep. So at the end of the accounting period, we're working on we end up creating an unadjusted trial balance. And again, these balances in these accounts are not correct. Okay, the accountant goes down and looks at each and every account. Okay, and as he looks at each and every account, he's making sure that that's the correct balance in those accounts. If it's not a correct, let's say for example, he's looking at $26,300 for this cash account. Well, he's going to look at a bank reconciliation. Okay, and I realize that you haven't covered a bank reconciliation so far in this in the subject in the first 3 chapters, but he's going to look at the bank reconciliation and see what the balance should be, and he does some calculations, and he says, okay, if that's if this is the balance it's supposed to be, then that's correct. But what if it isn't? What if that balance happens to be 25,780? Okay, well, it's not the same, and entries have to be made to make sure that it is what it should be, which would be the 25,780. Right? So that's where we're at in the process. We've created this unadjusted trial balance, and the account goes down account by account by account, making sure that those balances are correct. Now he does that when he's working on the worksheet. Okay, so if you can imagine, here's the worksheet, and everything here over is blank. I mean, yeah, he has an adjustment column, but really starting out here with the unadjusted trial balance balances. Here's all of the balances in the accounts, and he's going to look and say, is this account right? Is this account right? Is this account right? Is it right? If it isn't, then an adjustment needs to be made. And these adjustments are journal entries, which have to be put back on the books. Okay, so he gives the adjustments to the bookkeeper. The bookkeeper enters them into the computer system and creates a new adjusted trial balance. Well, that's what the bookkeeper gives them. Okay, the accountant does the math to create these balances, and then the accountant will take the adjusted trial balance from the bookkeeper that represents what's in the computer system and compares it to what he puts on this worksheet. And if there's a difference, he has to figure out why there's a difference and make a correction for it. Okay. So what are some of the corrections that need to be made? And now we're moving into the chapter 3 theory video. All right, but realize that I've gone through these first 3 videos trying to make sure that you're up to speed and understanding where you're at in the process, because it makes no sense to be at this point. You're at the end of the accounting period if you don't know what you're looking at. All right, so we have the unadjusted trial balance, and now we're going through these accounts, and basically at this point in time, there's two types of entries that can be made, correcting entries and adjusting entries. Now, correcting entries, all right, is basically just looking and saying, okay, there was an error on, and so we have to correct that original journal entry, all right? So let's just say, as an example, there was a debit to rent expense and a credit to cash. And let's say our rent for the month is $1,100, okay? But the entry was made as 1,010, okay? For whatever reason, the numbers were transposed, okay? Well, that entry is not correct. I mean, sure, technically my debits equal credits, okay? And debits have to equal credits. But as we're going down, as the account goes down through, and he comes down to the rent expense account, which let me just sort of see if I can find it here. Store expense, depreciation. Actually, there is no rent expense account on here, but neither here nor there. He'd come down to that particular account and he'd look at that balance, and if the balance in the account isn't supposed to be what it's supposed to be, okay, let's say he's looking at it and it's supposed to be 1,100 and he only sees that it's 1,010. Well, obviously it's $90 off. Okay, there was a $90 mistake, so the accountant needs to make a correcting entry for that amount. All right, for the $90. Right? Because the original entry is incorrect. So those are correcting entries. Relatively simple. Okay, maybe there's another quick example. Maybe something was bought on account from Home Depot, and then there was or maybe you sold something to a customer and you offered terms and the person returned something but yet had taken a quantity discount and a terms discount, but when the amount that they sent to you was incorrect. You're going to post that entry, but you need to maybe you made it the calculation was wrong, and you need to correct that entry. So that's kind of like what you do with correcting entries. Relatively simple. Right. The next ones, though, are not as simple. All right. These are, your adjusting entries. Now, why are we making adjusting entries? Okay. When we look at our set of books, the books are created either on a cash basis or an accrual basis. All right. The cash basis means that whenever you're going to affect cash, that's when you make an entry to the books. So everything is done strictly from a cash basis. And it doesn't matter when things occur. Like, for example, you have January and February, okay? And let's say that in January you make a sale, okay? But the person doesn't pay until sometime in February. Well, the sale was made in January, but when the cash was actually received, it was in February. So you end up using it from a cash basis perspective. You would not enter that transaction, which would be a debit to cash and a credit to whatever sales revenue, right? Until February, okay? Even though the sale was made in January, right? So that's the cash basis. On an accrual basis, okay, it brings into the concepts of revenue recognition and matching principle. Okay, we make the sale in January. Well, that's when we recognize the revenue. Okay, if we would end up making a debit to accounts receivable because we're extending credit, and we would credit our sales revenue. That entry would be made in January. That's when we're recognizing our revenue because that's when we made the sale. Okay. Notice we're not dealing with cash here. We're dealing with an accounts receivable. Okay. So this is an accrual. All right. We're saying, okay, we're going to show this at a at a different time. So then when in February we come along and the person pays cash, then we're going to debit our cash and we're going to credit our accounts receivable. Okay, that entry is made in February. Okay, so we recognize the sale in January, but we don't we recognize the cash received in February. And if you look at it, notice that we have a debit to accounts receivable here and a credit to accounts receivable, right? Between the two transactions, that debit and credit will cancel each other out, meaning it's not going to owe us anything. And our remaining entry happens to be a debit to cash and a credit to sales revenue, which looks that between the two of those, which looks exactly like if we had just recorded the sale in February as a cash sale. Okay, so what that allows us to do, on an accrual basis, it allows us to facilitate, a business. In other words, we need to recognize when we actually make the sale, right? Otherwise, we'd have to say, oh, well, we're not going to make the sale because in January because you don't have the cash, all right? No, you're going to want to make the sale, and you're going to extend the credit and allow them to, pay for it in February, but you made the sale in January. That's when the transaction occurred. Okay, it didn't occur in February when they're paying for it. Okay, it occurred in January, and you have to recognize the revenue in the appropriate accounting period. To go along with that, that's revenue recognition, but we have what's called the matching principle. And the matching principle says we have to match up our revenues with our expenses in the same accounting period. Okay, so in using the accrual basis, we're recognizing the sale, the revenue in January, which also means we have to match up our expenses in the month of January. Okay, so let me erase a lot of this. So what does that mean? Okay, well, as you can see here, there's kind of like two. Well, actually, I wrote these because that's the way it's being presented in the textbook as accruals and deferrals. And then they have supplies and depreciation. When it comes to adjusting entries, it all depends upon the general ledger accounts. Okay, remember, you're going to go down through each general ledger account and see if the balance in that account is correct or not. Now, accrual, and this is going towards this matching principle. When we make that sale, okay, we're going to make the entry in January, and we're going to recognize our revenue in January, okay? But we also have to match up our expenses. Well, on that day, that we made that revenue or in that accounting period, we also have things like, salaries that have to be paid and things like this, okay? And since our revenue was recognized in January, we have to match up those expenses in January also. These are called accrual entries, and I don't personally think of them in terms of accrual or deferral. I just kind of think of them in respect to when I'm looking at my chart of accounts and I'm looking at my general ledger accounts. I'm just looking at whether the balance is right or wrong. And over time, I just accumulated this inherent knowledge, meaning to know whether those accounts should be adjusted or not. For example, I mean, if let's say there's 30 days in the accounting period, right? It's monthly, and on the last time anybody was paid was on the 25th. Okay. Well, that means there's 5 more days that haven't been accounted for, right? Because we paid payroll on the 25th, but what about those remaining 5 days? Well, when we're doing the accrual basis, those 5 days need to belong into the previous accounting period where the revenue has been recognized, okay? They can't go over to the month of February. because those I mean, that's I made sales from the 1st through the 30th, so my expenses have to be shown from the 1st through the 30th. And that's what the matching principle is about. It's saying I have to recognize my expenses along with my revenues in the same accounting period. Now, if we were dealing on a cash basis, sure, I would have paid my payroll on the 25th, and then when my next payroll was, say, February, I don't know, I'm going to call it February 11th, okay? Well, when I pay my payroll in February, that's when I would record it, because that's when I pay out the cash. Okay, but using the accrual basis, we have to recognize our revenue in the proper accounting period, and then we also have to match up our expenses with those revenues. Right. So we end up making these adjusting entries for that. Right. Now, the next, if you're reading in the textbook, the next set of adjusting entries, they're calling them deferral. Okay, and the thought just popped into my head here. They're only really showing specifically like 4 different kind of journal entries. Okay, as you move further into the textbook, this will expand. It's not like, oh, these are the only ones. No, there's going to be other ones. Okay, so if you're into this, memorizing what's in the textbook and going and looking it up on a specific page in order to work through the problem, realize that that's not going to cut it, because there's going to be other entries that are going to be made for your adjusting entries at the end of the accounting period. Yes, you will be shown the most common ones, but there's no book in the world that's going to be able to tell you how to make all the adjusting entries to cover every particular situation. Yes, the book will show you the most common ones, and you're going to use those 95% of the time, and realize that these 4 of the accruals, the deferrals, the supplies, and depreciation are only a part of those most common ones. All right. So I just talked about accounts receivable and salaries payable, but now let's talk about deferrals. And deferrals is sort of like what you call putting off, right? And basically, these two are the same side, are 2 sides to the same coin, right? For example, let's say you have a mall, right? Now, the owner of the mall has their books, okay? You have your books, and you want a space in the mall, okay? Well, prepaid, and I'm going to use an example called prepaid rent, but this applies equally to advertising, utilities, anything that you prepay, okay? Let's say the rent is going to be $1,000 a month for 12 months. And it's the 1st of the year, January 1st, okay? Well, on January 1st, you're going to prepay $12,000, right? 1,000 times 12 is $12,000. That's going to be an entry you're going to make on your books, all right? So you're going to debit prepaid rent, and you're going to credit your cash, because you're paying, that's 12,000 and that's 12,000. You're going to pay the $12,000 for the prepaid rent. Well, that's on January 1st. Okay, this prepaid rent is an asset account. It's something you own. You still haven't used it yet. You've just given it to the owner of the mall. Okay, so your 12,000 is going to be shown on your books as prepaid rent, right? But when it's received by the mall owner, okay, that for them is a liability, right? It's something that they don't own, all right? Sure, they have the money, and they'll put it, what they'll do is they'll debit cash because they're receiving the cash, and then they'll credit unearned rent revenue for the $12,000. It's unearned. They didn't earn it yet. Sure, it's for you're paying the rent, but it sits on their books as a liability as of 1/1. Okay, why? Because it's money that they don't own yet. All right, you haven't used it. You haven't used it up. So at the beginning of the accounting period, okay, you have on your prepaid $12,000. Okay, and on their books they have unearned rent revenue $12,000. Okay, now, and let's call that beginning of the accounting period January 1st. When you get to the end of January, now you've used up 1 month's worth of that rent. Okay, but notice that there was nothing to trigger that transaction. All right, it's just an adjusting journal entry. You have to look at your prepaid account, or in their case, they're looking at the unearned rent revenue account, and when they see, and I'm going to use prepaid here, when the account is going down through the general ledger accounts and he gets down to prepaid and he sees 12,000, he's going to say, well, that's not right because this is the end of January and that means there's only 11 months left. So and we've used up 1,000 of that $12,000. So we have to make an adjusting entry for that 1,000. That's what a deferral is, and because it's something that happens down the road, and we have to make an adjusting entry for that 1,000 in order to make sure that the balance in the account is now $11,000. And the same thing is going to happen on the books for the mall. They're going to look and say, "Oh, unearned rent revenue. Well, we earned 1,000 of that. It's so what we still owe is if that person said, oh, I want to leave the mall now, closing up shop, we'd have to give back the 11,000, but they'd keep the 1,000 for the month of January. Okay, so their books show the unearned rent revenue as being 12,000, when in reality it should only be 11,000 because of the $1,000 in rent being used. So they have to make the adjusting entry for that. Okay, so that's what the deferrals look like for the adjusting entry. All right. And now I'm already at 22 minutes, almost 23. So I'm going to stop here and then pick up in the next video with the remaining adjusting entries.